Good afternoon. You're watching BloombergQuint Live. Here are the top headlines. Indian markets recover from early morning jitters to trade flat. Dr. Reddy's is the top Nifty gainer after its Srikakulam plant gets an all clear from the US FDA. Dollar strength takes the rupee to a fresh 6-month low. The Indian currency drops to its lowest level since March 2014. The government may revise gas prices higher for the first time in 3 years, according to a Bloomberg survey. The economy has troughed, says Morgan Stanley, predicts that the Sensex will hit 1 lakh by 2027. And now it's over to Darshan Mehta for Hot Money.
Thank you, Alex. Hello and welcome to Hot Money on BloombergQuint, India's first digital live business streaming channel. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Joining us on the show today is Avinash Gorakhshekar of Joint Ray Capital, who expects overall markets to trade in a close range today as volatility could be high due to FNO expiry. Independent investment advisor Vivek Mawani expects a correction over the next few months, and Savi Jain from 2.2 Capital is cautious on the market. Today on Hot Stocks, we will discuss Divi's Lab, HPCL, Reliance Industries, Bajaj Finance, Avenue Supermarts, that is D-Mart, and Shriram Transport. Now let's move to the first stock itself. It's one of the stocks that has been buzzing over the past few days. Divi's Lab, it's up almost 2%. The counter was down 10% yesterday. Everything is out now in the open for Divi's Lab. You know, the 483, the earlier 483 is out, the new 483 is out. People can interpret whatever they want and they can dissect it. But how does life change for Divi's Lab post this Firm 483? Avinash, what's your view on Divi's Lab currently? Now everything is out in the open. People know, they've read the Form 483. The import alert still stays. What would an investor or a trader do for Divi's Lab now? What should they do?
I think, Darshan, clearly, I think the 483 is out. There is good clarification on the, on the outcome. But I would believe that, I think unless we get a clear sense on the earnings, at least for the second and third quarter, I would be a little skeptical because, the way the stock has actually been beaten down from the higher levels, I would believe that, it's better to wait for the second quarter and then take a view. I think overall, medium to long-term prospects look good. But in the near term, I think some key challenges could still come because, these are procedural observations. How they impact the output from Vizag is going to be very critical. Any
timeline that you believe that Divi's will take now before the entire process gets streamlined or probably the import alert gets lifted?
I think for these kind of issues, I think you need to give it a time of at least 3 to 4 months, Darshan. I think it's difficult to presume that within a fortnight, things get back to normal. But I think within a quarter, I think one should definitely have a clearer sense from the management, from the body language and the management commentary.
Savi, do you agree with Avinash? Do you believe that these are procedural in nature only?
No, so I think the companies come out with a notification that it's procedural. But if you look closely at what the exact words are, there are issues around quality, contamination, impurities, etc. They talk about not doing quality checks for batches which are dispatched, API batches which are dispatched, and they also give hints about some kind of data integrity issues. So I think these are slightly serious in nature, and I think we'll need to wait it out and see how the US FDA is going to come back on this. Overall, I think incrementally it's slightly negative from where they were in December 2016.
But do you think that there is any chance, since I believe you are a little more aggressive in terms of saying that it's not totally out of the woods here, how much timeline would you give Divi's to come out of this and an import alert be lifted if these do prove to be procedural in nature?
So fortunately for Divi's, this was a record fast re-inspection, and they should have come out of the woods in this inspection itself. You don't get too many chances from the US FDA. Unfortunately, they messed up on this, and I think it's not going to be very easy for the import alert to be lifted very soon. They will have to, you've looked at companies like IPCA, etc., which have taken very long periods of time. This was the API supplier, so it could be slightly faster, but still, I don't think it's going to be easy.
Vivek, do you track Divi's Lab?
I don't closely track Divi's Lab, or as a matter of fact, I'm not very positive on any of the Indian pharma company who have regulatory issues as far as the US FDA is concerned. But I'm not bearish on pharma.
So what do you like?
So companies which are focused on the domestic market, let's not forget the Indian domestic pharma market is also fairly large. That's number one. highly profitable. It generates a very high return on equity for most companies who are focused on the domestic market. So among the large companies, Cipla is my preferred pick. In the mid-sized companies, Alchem, which is fast, which I could say 10 years down the line, it will have a similar profile as what Cipla has today.
But do you believe that we are over the GST issue that has happened for domestic pharma companies?
Maybe not, but I think it's a matter of time, maybe a quarter or so of hiccups, and I think we'll get over those issues in terms of supply issues, inventory pipeline issues, traders, I mean the trade channel not getting the credit for older stock and so on and so forth. But I think those are transitory issues, and over the next couple of months those should get corrected.
Okay, so that's the view that's coming in as far as Divi's lab is concerned. Avinash and Savi both are slightly bearish on Divi's. Vivek doesn't cover Divi's, but he prefers the domestic play. So he's saying go ahead and look at companies like Cipla or an Alchem lab, which have significant exposure to the domestic market. Now let's take a look at the second stock, and that is HPCL. Probably not the best month for the oil marketing companies. In fact, last month was one of the best months that they had with super moves that came in. Now, one of the big triggers for HPCL is that the Nifty rebalancing happens tomorrow. And one of the counters that will come into the Nifty will be HPCL. Does life change for HPCL because of the Nifty inclusion, or are there serious issues as far as business is concerned? So let's ask our experts. Vivek, any view on HPCL, any impact of the Nifty inclusion, and overall what do you feel of the business cycle?
A couple of things with, I'm neutral on HPCL. Actually, I'm negative. I'm only neutral because of the Nifty inclusion. So a lot of funds who track the Nifty or international funds, ETFs and index funds, per force would be forced to buy HPCL for a long time. They will continue to be net buyers in HPCL as their AUMs grow. Having said that, from the business point of view, it's clearly not very good for HPCL. Two things. One is the acquisition or merger with ONGC. That's one thing which I'm negative about. Number two, the gross refining margins, which in the last quarter clearly were very high thanks to some refinery shutdowns in Europe and US in the last 1 month thanks to the hurricanes, etc. A lot of those issues are getting corrected. So probably over the next quarter or two, we should see a correction in the gross margins, gross refining margins on HPCL. So on the earnings front itself, in the near term, we are going to get hit. Medium term, the acquisition and merger with ONGC and MRPL, how it plays out, most likely, if history is to be taken as a guide, such kind of mergers and acquisitions don't really create value for anybody, as a matter of fact, except maybe for the senior management of the company and the consultants who advise such mergers. So I'm basically negative to neutral on it.
Okay, Savi, do you agree? Are you negative, positive?
Yeah. So I am also negative, but we are long-term fundamental investors, and these kind of events are short-term in nature. They can very well be out of the index in the next rebalancing. See, HPCL has had a phenomenal run in the last 5 years. The stock has almost increased 7x, 8x because of a host of tailwinds. One is the record low crude prices in the last few years, which has led to very high marketing margins for these companies. And second is the deregulation of oil prices by the government because of the low prices. Now, both of these have led to record high refining margins and marketing margins for a company like HPCL. Now, to give such kind of high multiples on these kind of EBITDA margins, which may not be sustainable is actually, I think, not warranted. And given that crude prices have already started increasing due to production cuts by OPEC, etc., this will lead to a decline in the marketing margins. Also, government is under a lot of pressure to decrease the taxes that it is levying on the fuel prices. So there is, although the government has clarified that it's not going to intervene in the pricing of fuel, but given the political pressures and the general election which is going to be there in a couple of years, it may very well start regulating the prices again, and that will lead to...
That could be a big negative.
Yeah, that could be a big...
I believe you are agreeing with him, you're nodding.
Savi's points are right. I think first of all, government is in a mood to cut fuel prices. So obviously that means there's a cap on fuel prices. Secondly, I think crude prices have started rising, so obviously GRMs in the coming quarter may not be all that great. And finally, the near-term trigger for the market was ONGC makes an open offer for HPCL, which is not going to happen. So I think that also makes the possibility that no medium-term, at least short-term impact on the stock would come in. And yes, the Nifty inclusion could possibly put a spike to the stock maybe in the near term, for some sort of index rebalancing. But overall, I would say that it's better to stay put and wait and watch, because probably for the next couple of quarters, margins are going to come down. And I think as Savi said, margins to be maintained at these levels would be a difficult kind of proposition for the company.
Okay, so that's another consensus view that we are getting on HPCL. All three our guests believe that it's not the best time to invest in HPCL. A little bit of support can come in because of the Nifty inclusion, because some of the funds who are linked to the Nifty may buy, but overall fundamentally valuations don't support. Let's talk about the third stock, and I think all our guests will have view on this. It's Reliance Industries. Now, Jio seems to be the big play, but Reliance over the past few days has not been working significantly. The stock price is down in today's trade. What do you like about? Do you like Reliance, Avinash? And what do you like about Reliance?
I think, Darshan, frankly, Reliance has got a much more broader product base. It doesn't have the problem of government interfering into its pricing. More importantly, I would believe that I think from a longer term perspective, Reliance can definitely outperform from its telecom business. Probably FY19 is going to be a year when they could operationally break even on that business. But my sense is the GRMs, if the company even manages to maintain what they did in the previous quarter, that could be a very big kind of a positive sentiment driver for the stock. Overall, I would believe that the stock may remain a little under pressure or maybe underperform because crude prices are moving up. But overall, I think once the numbers come out, I would believe anything below 800 is a good price to actually nimble in if the outlook is going to be for a time period of at least 18 odd months.
Did you say Jio will break even early?
Operationally break even.
When do you see that happening?
Probably by the second half of FY19.
Do you believe, Savi?
No, I strongly disagree with that. And I know if you're looking at EBITDA, I think that's not a correct metric. There are huge interest costs, there are huge depreciation costs. And till now, the Reliance has been capitalizing most of the costs that it has incurred in Jio. What I feel is that going forward in FY18-19 onwards, all of that will start hitting the EPS of Reliance, because till now it's almost been next to zero because they've been capitalizing all the costs. And I don't believe that Jio is going to garner significant market share. There are worthy competitors in Bharti and Vodafone plus Idea. And the IUC, which is a positive trigger for Reliance, that itself can be transitory, because Bharti and Idea and all have gone to the courts, and the telecom sector is not in a very good health. It's possible that the courts may roll back these IUC charges, because globally IUC is there as a fact for all the telecom companies. So
I think Avinash wants to respond.
Savi just wanted to know, on the EBITDA front, I agree with your point that they may make operational losses, but in terms of the balance sheet leveraging, what is your thought process on, say, a Bharti or maybe a combination of Vodafone and Idea? Because the debt on the balance sheet is so huge that now I think if you compare it with Reliance, which has got a net cash kitty of almost 70,000 odd crores, don't you think this will be a kind of a key differentiator when they go out in the market and compete?
No, so just because Reliance is better than Idea plus Idea, Airtel and Vodafone, it does not become on an absolute basis a good play, because I don't see Jio making double-digit ROEs in the next 10 years, because Reliance has spent close to 2 lakh crores on the telecom venture, and for it to make economic profits on that is going to be very difficult.
Vivek, which side are you on? Do you believe with Avinash or do you believe with Savi? Or you have your own view now?
Well, I have a neutral view on Reliance. While Jio makes a lot of front page headlines, it grabs everybody's attention. Let's not forget the company's revenues and earnings are driven by its core business, which is refining and petrochemicals, and which seem to be doing quite okay with very high refining margins, which could maybe correct to $10 whereabouts against $12-13 that we had in the last couple of quarters. So that's a data point to watch out for, besides just the Jio subscriber addition. Jio subscriber additions don't add to profits, nor do they significantly lower the losses that Reliance makes on Jio. That's number one. Break even on Jio, to my sense, I think anything expected post interest and depreciation costs, anything before 2020, I think is a bit too ambitious. I don't think even Mr. Ambani or the senior management is probably budgeting for that, and that seems to be the consensus even among the market participants. So the point Savi made, whether Jio will make double-digit ROEs in the next few years. Well, actually, even their core business does not, if we look at the consolidated balance sheet and spread, even the core business makes ROEs of about 12-13%. So, and with geo losses, I mean, there's a risk that the whole business, the ROE drops depending on what kind of losses are accounted for in the because it's only from the last 2 quarters that they have started accounting for operational costs on their P&L. Last financial year, it was all capitalized. So, given the sharp run that we have had in the last about 9 months, I mean basically in 2017, I'm neutral on that. I think the stock will go through a phase of consolidation, be in a range bound movement of about 10 to 15, on the higher side 20%. So now it's more of a trading play than an investment play.
Okay, before we move on, here's a quick recap of all the stocks that our guests have covered till now. We did cover Divi's Lab, we did cover HPCL, and we also covered Reliance. So this is what our guests have been talking about on all these stocks. Okay, the next stock is a stock which has moved significantly, the FII's darling Bajaj Finance. Now the story happens is, what do you choose? Do you choose growth or do you choose valuation? Savi, let me tell you. Well, let me come to you first. What do you like? Growth, valuation? What's your view?
So we are very conservative investors, and we would not invest in one of the most expensive NBFCs in the world, for sure. Having said that, Bajaj Finance is a wonderful franchise, and it is diversified across assets. It can toggle its growth rate between the asset classes depending on where there is stress and when there is not. Now, optically, the valuation looks cheaper now because the company has done a big QIP at a record high valuation, and the valuations now optically look cheaper, 6+ price to book as compared to close to 9+ price to book. But even at current levels, I don't think it is possible to make money on Bajaj Finance by investing at these kind of levels. For a company that makes 20% ROE, and those ROEs are also at risk because banks are, now are concentrating on the private consumer space. So I think.
But what's with Bajaj Finance that people are ready to put in QIP money at such valuation, and it continues to go up?
Well, they have had a phenomenal execution track record over the last 7-8 years. They have grown at 30% plus levels forever, and the asset quality they've been able to maintain across most of the asset classes. Wherever they see stress, for example, they're seeing stress in LAP now, so they're moving away from LAP and they have 10 to 15 different sub assets which they can concentrate on. So I think it's the execution, it's the DNA of the company. You can talk to anyone at the other NBFCs and they are not even close to where Bajaj Finance is.
Do you believe, Avinash, no one's close to Bajaj Finance?
I think looking at the kind of balance sheet growth of 20-25% what the management has targeted, I would not be surprised that I think what Savi said is right, that maybe in the near term valuations look more or less fair. But if you look at the next 2 to 3 years, I would not be surprised PSU banks or maybe other entities would not be able to make that kind of impact, especially on the execution side. And since they have actually raised a huge amount of money from the QIP issue, their capital funding exercise has now got completed for the next 2 years. So I would believe that this is a stock which is a portfolio stock. Next 2 to 3 years, one could definitely expect a good amount of wealth being created. I think at the end of the day, it is going to be the management, the style of delivery. So I think all said and done, it's an expensive stock. But yes, quality comes at a price, and I would definitely be surprised if there's some sort of derating. In fact, the stock could possibly hang on even if the market corrects.
Vivek, growth, valuation, which side are you on?
Well, I'm on side of valuation for obvious reasons. But you can't take away the credit for a company that has delivered quarter after quarter, year after year over the last 10 years consistently. So, I mean, this is like an HDFC Bank in the NBFC space. I mean, the kind of track record which HDFC Bank has had. I mean, Bajaj Finance has a similar or even a more superior track record from that point of view. But as Avinash said, quality comes at a price, and here the price is a bit too stiff. I mean, is a bit too aggressive. The company may continue to grow over the next couple of years. I do, at least at this point of time, there's nothing to believe that the growth is going to hit a roadblock or a speed breaker for whatever reason, at least at this point of time, for whatever information is available. But as the earnings continue to grow, my sense is valuations also will correct over a period of time. So I'm not saying the stock will crash or that there will be a derating, but earnings will catch up, and hence your 6 times book value or 7 times book value will probably normalize to 3 to 4 times book value over the next 2 to 3 years. So the super returns that we have got over the last 2, 3 or 5 years, maybe those super returns may not continue. Probably you will have just muted returns over the next 2 to 3 or 5 years. But I would tend to agree with Avinash. Yes, it's a portfolio stock. I mean, you can't keep having 50% growth year after year. I mean, you've had that in the last 5 years, but I don't think next 5 years will also give you that 50% growth in stock price.
Okay, so that's the view that's coming in on Bajaj Finance. Avinash is bullish on Bajaj Finance. He believes it's a quality franchisee, but Savi as well as Vivek are rather neutral. They believe that the valuations is a little too rich. They would wait for some bit of correction to come in. The next one is very interesting. Again, it's the same story: growth versus valuation. One of the stocks which has been actually the IPO of the year. D-Mart, Avenue Supermarts, it's almost, it came in at a price of 299, it's already 1000. There are some brokerages which actually value the company on FY29 and give a target price of 1600. I don't know how whether you should do that or no, but let's ask our guests. This is an interesting stock. Let me start with you, Vivek. Avenue Supermarts.
Well, here too, you can't take away credit. You have to give credit to the promoters and the management. A very superior business built on high in a sector where margins are difficult to come by, return on equities are even more difficult. And here you have a company that does both of that, plus adds 25% or 30% top line and bottom line growth. That's the track record that they have done. Maybe it can continue. I'm not ruling that out. But let's not forget, it's great companies that make great stocks, not vice versa. Just because the stock has done well, does not really, you just can't extrapolate a 6-month price movement to a 10-year price movement simply based on that. And I'll just take a minute and draw a parallel. If we were to go back to the 2000, the IT boom, Infosys, Wipro, and all of them were very richly valued. The underlying business continued to grow at 30% for 5 years, even after the technology bubble burst in 2001. So till 2006, somebody who bought in 2001 did not break even on his investment in 2006, in spite of those companies delivering 25-30% earnings growth for the 5 years after that. I'm not saying something similar can happen in D-Mart, but let's not take away attention from that possibility also, that the company may continue to grow, but at 70 times earnings, maybe 3 years down the line, it will normalize to 20 times earnings, and you factor in the earnings having caught up during that period. So,
Avinash, you see,
I'm sorry.
Avinash, I'll move to Avinash. Avinash, you are very bullish on D-Mart. I can see it in your face that you would want to say that you're bullish. Are you?
No, I think I'm bullish on the entire organized retail sector. And as Vivek pointed out, I think valuations definitely are expensive. They're not cheap. I think from the IPO price, afterwards it got listed. Then again, the stock got re-rated. I would believe that on all metrics, the inventory management, the EBITDA margin, the return on equity, I think on all parameters D-Mart has done well. But yes, if an investor is looking for the next 4 to 5 years, then I think one can hold on. I think look at a dip to buy it, because obviously these stocks, the liquidity factor also plays a big role. Hardly 18-20% is the public float which is available, and I don't think the management is in a mood to
That's what I wanted to ask, because see, it's a 75,000 crore market cap, but the free float is 5,000.
Exactly.
So what should a retail investor do? Because if you because it can move up on a very high base because the free float is so low.
But I think those are non-fundamental reasons for the prices to move. And
so you are bearish on?
Yeah, if you see
what's your reason?
Slightly bearish market, I think these kind of valuations are not sustainable. We are seeing an increasing trend of analysts projecting for the next 10-15 years to justify the current valuation, or even meriting a 50% upside from current valuations. People are talking about 100x FY19 earnings. We have not seen these kind of targets ever, I think, in any business. So overall, it's a super franchise, but I think there are two key risks. One is that there is competition. It's a very plain vanilla offline retailing model. You look at companies like Reliance Retail. Reliance Retail is headed by Damodar Mall, who was the co-founder at D-Mart. So he's very well aware of what the secret sauce for D-Mart is, and I don't think it's impossible to replicate that. So they have a huge number of stores. They will get their act together. They already have. Then there is Future Group. There is Aditya Birla, etc. So that risk is definitely.
You're saying competition will somehow catch with them, and these valuations will. It's one mistake that will happen, and that could bring valuations down. Is that something that you could say?
they have captured some of the best properties in the country. There are 125 really good locations. They have not closed down a single store ever. But to do that at this kind of base going forward, to find those kind of assets, buy them, I think it's going to be increasingly difficult.
Yeah, that's what, see, Avinash, that's what I wanted to point out. You're bullish, but because the base is increasing now, can D-Mart continue to grow at this base and such valuations like 100 times? Is it sustainable?
See, I think valuations could possibly come off, but if you talk about the business, Darshan, I think the kind of throughput which they are generating, sales throughput, I think that is going to be the key trigger. They still operate on a net margin of just 4%, like normally every retailer does. So I think as long as they are able to remove more and more sales throughput, I think that is the key. Once that starts slowing down, then obviously valuations will take a hit. But at least in the near term, at least for the next say couple of years, or say 2-3 years, I don't think on this kind of base it looks as if sales are going to slow down.
Okay, so that's the view that's coming in on D-Mart at this point of time. Avinash is bullish on it, but everyone, the common concerns is that valuation is rocket high for Avenue D-Mart. Let's talk about Shriram Transport. The counter has been on focus, was one of the best gainers in trade yesterday. It's a matter of deal or no deal. So now everyone's waiting. The deadline is coming very, very soon. Savi, let me start with you. Would you prefer this deal to go through, or would you not?
See, I think everyone is committed to the deal, but I don't think it is going to be in the form that it was announced earlier.
You expect a revision?
Yeah, there's clearly for Shriram Transport, I think it's a very good, very big positive. I don't think it's anymore going to be a part of, it's not going to be a subsidiary of IDFC, the holding company. Reason being that one is it would have led to a significant dilution for the IDFC shareholders, because the market cap of IDFC and Shriram Transport are almost, Shriram Transport is close to 40% of the valuation of IDFC. So that is one reason why shareholders will not allow that. And secondly, Shriram Transport shareholders, most importantly, for them they would have had to have a holding company discount, because they would get shares of IDFC instead of their shares that they are currently holding in Shriram Transport. That was one negative. And secondly, I don't think there was any synergy between Shriram Transport and IDFC Bank, because SCUF was being merged into IDFC Bank, but Shriram Transport was going to remain an independent entity.
What about you, Vivek? A minute, please. What's your view on?
Oh, I'm absolutely negative. I'm absolutely negative on this whole deal. And from the day the deal was announced a few months ago, I've been like, the first thought and extreme thought, I said, hey, have they really gone mad or what? Why would Shriram Transport, which has built a fantastic business in commercial vehicle finance under Shriram Transport Finance and SME lending in Shriram City Union Finance, agree to this kind of a merger, which clearly seemed to have been brokered by Mr. Piramal, who owns a significant minority in the Shriram Group. That's number one. Firstly, that's number one. Number two, there really are no synergies between the Shriram business and the business of IDFC. IDFC clearly has been a rank underperformer over the last several years, whether it was in the infrastructure financing space. Last 2 years, they've got the banking license. Even on the commercial banking side, they've really not been able to scale up as one would have expected from their first name as IDFC and very talented senior set of management. So it's been clearly an underperformer. And
I'm sorry, I'll have to cut you.
Yeah.
We're running out of time. Avinash, your final word on
I think
Transport.
I would like to second what Savi said. If this deal is not going and it comes into a kind of a revised package, I think that would be a big booster for Shriram Transport, because nobody was going to like the idea that Shriram Transport becomes a holding company. The kind of valuations this company can throw up, even from the current levels. Our calculation is that it trades at a price to book of roughly 1.8 and 1.6 times FY 18 and 19. So I think there's a lot of value in this franchise, provided this merger does not happen, or if it happens, it's going to be in a revised package. So all said and done, over the longer term, this business is a very attractive business. The deal should not happen. My sense is that would possibly be a key re-rating trigger for this.
Okay, the re-rating trigger, according to Avinash, for Shriram Transport could be that if the deal doesn't go through. Avinash is bullish on Shriram. Savi is also bullish on Shriram Transport, while Vivek is usually negative on Shriram Transport. Thank you so much to our guests for coming on the show. But before we wrap on the show, here's a quick recap of what our guests have said on the stocks that have been covered. Thanks for watching BloombergQuint.